And on this morning's Ag Issues program, as always, a pleasure to bring on to the program Roger McEowen, Professor of Agricultural Law and Taxation at the Washburn University School of Law, as he joins us on the program this morning. Roger, good morning. How are you?
Good morning, Greg. Just fine, thank you.
All right. We don't do this very often. I think at least with you and me, it's the first time I've done this. But you heard some comments on our agricultural news that you wanted to comment on. So what I'm going to do is I'm going to reread this story and play the audio cuts and give you a chance to talk about this. This is concerning, of course, stepped-up basis. That tax break specifically is still in the Biden administration's crosshairs, based on recent congressional testimony, as Congress enters 2 critical weeks to decide the fate of the controversial President Biden's Build Back Better budget and how to pay for it. Administration officials are keeping alive a proposed elimination of the step-up basis, key for offsetting farm transfer taxes at death. Now, here is USDA Secretary Tom Vilsack at a recent House Ag hearing.
If the farm continues to be owned and operated by the family, there is no impact. There is no tax due. There's no capital gains that's due at that point in time. Secondly, if, in fact, at some point in time in the future, the family decides to sell the farm and get out of the farming business, there are exemptions, $1 million a person.
But Southeast Illinois GOP Congresswoman Mary Miller wasn't
buying it. Are you saying that rolling that back is not going to affect the family farm or ranch? Did you just say that rolling back the stepped-up basis is not going to affect them?
And the Secretary answered the question
this
way.
ERS has taken a look at this, and they have concluded, not once but twice, that roughly 98% of family farms in this country are not going to be impacted and affected by this.
And Roger, you get a chance to hear it once again. So your comments on what you heard from the Secretary.
It still affects my blood pressure the second time I heard it the way the first time I heard it. That is just flat out incorrect. It's misleading on a number of points. Let me walk you through this. And first, I would say this. A couple of weeks ago, we thought, as I visit with the tax writing committees and work through some of these things, that step-up basis proposal in the House was dead because the votes are not there to eliminate the current step-up rule at death. It's definitely dead on the Senate side. And so I still don't think this is going to go anywhere. I am somewhat surprised if that audio is within the last 10 days that the Secretary of Ag is still saying these things. But let me walk you through and address why his comments are inaccurate. The current exemption from federal estate tax is $11.7 million per decedent. So for a married couple, that's just a little bit under $24 million. That's $23.4 million, and you get portability of any unused exclusion at the death of the first spouse that can carry over by an election that has to be made to the surviving spouse. Okay, the proposal that's on the table, one of them, is to decrease that federal estate tax exemption down to $3.5 million. A second proposal, and this is where I start to get into what the Secretary is alluding to without giving any details and making some vast assumptions in what, as he's saying it. One of the proposals is to decrease the federal estate tax exemption down to $3.5 million, couple that with no basis increase at death, and add in a provision, and this is the specifics of behind what he's alluding to, of special use valuation, which is a provision that allows you to value farm and ranch land in a decedent's estate at death equal to its value for agricultural purposes rather than its fair market value. Historically, what we've been able to do with that election, and I've done a number of these over the years, and I would venture to guess the Secretary has done absolutely zero of these in his career. He is an attorney, but he's never dealt with farmers and ranchers in his legal career, and he's never dealt with tax. So I can be pretty assured he doesn't know how 2032A works. He's never filed one of these. He doesn't know the requirements that a family has to satisfy to make to be able to claim the election or stay out of trouble for 10 years after death. what you can do with that election, not only can you drop the value of the land down to its ag value in the estate, but there's a cap on how much that reduction can be. In 2021, for deaths this year, that maximum amount of reduction is $1.19 million. That will increase to slightly over $2 million next year with an inflation adjustment. The proposal that's on the table is to allow that decrease to be capped at $12 million. So there's been some confusion that I've picked up in the media about that $12 million that says farmers and ranchers will get a $12 million exemption. No, that is specific to special use, saying that you can decrease the value of the land in the estate by $12 million by making this election on the decedent's estate tax return. Okay, so let me give you an example. Let me put some numbers to this, and this will show you where the Secretary is inaccurate. Let's say I have a current farm and ranch that the taxable estate value is $9 million. Under current rules, we have no federal estate tax. Of course, in Kansas, there's no state estate tax either. And you get, under current law, step-up basis at death. So that means that the heirs will inherit that property with a basis equal to the fair market value of that at death, so $9 million and no tax. So we start, again, we've wiped out all that appreciation in value since the decedent started owning that property. It goes to the next generation with no tax, and you get a step-up basis. Now, if the exemption drops to $3.5 million and we still have that $9 million taxable estate, we're $5.5 million over. We can make a special use valuation election in the estate. Since we can reduce the land value by up to $12 million, we still get to, if we've got enough land to do it. Now, that's the other thing that's here. If we've got enough land where we can get a $5.5 million reduction in value to get us to the 3.5. Now, that's a big if. We may not have enough land. So this would only be beneficial if I have a large ranch or a large farm. Small farming operations, no, you're not going to benefit from this. Say you've got $9 million taxable estate, but a lot of that is non-farm property. Let's say you've got $2 million of farmland and you've got $7 million of stock portfolio, those types of things. So, it's a good-sized farming operation, small farming operation, but most of your wealth is not in farm and ranch land. You're not going to be able to make the special use valuation election anyway. But if you don't have enough land to drop it down to the $5.5 million, you still have an estate tax obligation if that exemption goes to $3.5 million. But let's say that we've got enough land to take it down. So we get it down to $3.5 million by making the special use valuation election. There is no estate tax. And so that's where the Secretary is saying, well, this isn't going to affect farms and ranches because we can make that election. And if it stays in the family, remember he said that too, this is what he's alluding to, then there's no problem. And you get $1 million exemption from capital gains tax at death. Well, let's pick through that. So now we've got it down to $3.5 million. There is no estate tax. But to get that to be no estate tax, now you have to make an election in the decedent's estate to value that farm and ranch land under Section 2032A to get that down to $3.5 million. What does that mean? That means that the prep fees on that are going to be about $10,000 to $40,000. I've done a number of these, Greg, over the last 30 years. Depending on how complex it's going to be, you're looking at least $10,000 to do this. And I've had one that was $40,000 that was the total fee for the firm I was assisting with to get this all done. That is a cost that the family has to pay. So that goes to the law firm that's doing this. Now, Secretary Vilsack is an attorney, so he's not going to do something that's harmful to the legal profession. So that's a transfer cost from the family to the attorneys. And now you have, if this goes through, loss of stepped-up basis. So if the farm stays in the family for the next 10 years, then you don't have a problem, but there's a whole host of requirements the family has to satisfy. One of those means that you can't cash lease post-death with a couple of very minor exceptions, or you're going to have to pay all the tax that you save by making the election back. There are a whole bunch of requirements that have to be satisfied by the family to be able to make the election. There are requirements that the estate has to satisfy at death. and there are a bunch of requirements the family or the qualified heir must satisfy for 10 years after death. You violate any of those rules, you're either not going to be eligible to make the election in the first place, or you're going to have to pay recapture tax after death. Now, on the $1 million exemption, this farm property often will go to one child, not multiple children. Remember, the Secretary said, well, you have $1 million exemption for each heir. That doesn't always apply. In fact, it doesn't apply most of the time. You have the farm that goes to one child as the designated farming heir, so you get a $1 million exemption on the lack of basis step up at death. The balance of that property is not going to be covered by that $1 million exemption. So now you have, in addition to that, now you have problems with tracking basis for the practitioners that are involved. That is also a nightmare for the tax practitioners to have to deal with any type of rule that is other than a complete basis step up at death. We went through this problem in the late 1970s. The 76 Tax Act took out stepped up basis. It became unworkable during the Carter administration. The tax profession complained so loudly that it's just absolutely unworkable from a practice standpoint that we have to have stepped-up basis. So the repeal of stepped-up basis rule was repealed itself, and step-up basis at death was put back in. So there's a quirk in the law along about 77 and 78 that we still deal with to this day with respect to jointly held property between spouses. And interestingly enough, the current president, who was in the Senate at that time, voted for the repeal of stepped-up basis and then voted for the repeal of the repeal. So he's on both sides of the issue. So it's hard to tell, where the White House is at on this historically, although with this still rattling around, obviously they're pushing it. That is the truth behind the comments that the Secretary has been peddling out there. And I'm aware of the ERS data that's out there, but it is also inaccurate. It's inadequate because it doesn't connect all of these dots. Bottom line, just the vast majority, just about all farms and ranches would be impacted by the combination of these three proposed changes that they're thinking about. Now, do I think they will occur? No, I do not think there is political support for this. That's what the committees are telling me, the drafters of the legislation that we work with on this, saying, there's no political support for this, or there's not enough on the House side, because there are several prominent Democrats in ag districts that will not vote for this, one of which is in Iowa, and that's a big deal. And it only takes one vote in the Senate to kill it. So I don't think at the end of the day this goes through. But the lady I heard on your clip that you played that was questioning the Secretary, she's absolutely right in raising those questions, because the dirt's in the details on this, and the details are not in the Secretary's favor.
Roger McEowen, Professor of Agricultural Law and Taxation at the Washburn University School of Law, joins us. And Roger, one topic we do want to discuss this morning, and of course, if you're a rural landowner, you sometimes receive payments from, say, utility companies, oil pipeline companies, wind energy companies, or other rights for rights of way of easements over their property. And I know that's the tax issues specifically with easement payments you recently talked about in a recent post.
Something we may need to revisit on a subsequent program, because we're running out of time this morning. Your guest went a little bit too long on the response to the Secretary's comments. But you're right. We do see this a lot in agriculture of farmers, ranchers, rural landowners receiving easement payments. Might be from a utility, might be from an oil pipeline, might be from an energy company. And then we get into issues as to what is the tax classification of those payments? How do I report those? Are those income to me? On what form of the return do they get reported? Can I reduce my basis in the affected land by the amount of the payment and therefore offset the taxable amount by by not reducing my basis, but capitalizing it into the land. So there are a number of issues that can come up. So the way I step this through, and this is my post of last Thursday, October 14. I start that post with how you characterize properly the transaction. So you might have income recognition, or you could offset the payment fully or partially by your basis in the land that the easement impacts. And that's an issue right there. How much of my land does the easement impact? Well, one way we answer that question is, where is the easement in relation to your farm property? Or is it running down a fence line? Is it bisecting your property? Is it affecting the use of your farm everywhere, or just on a part of the land? And so that's a major issue. Is it a sale, or is it really a sale of the property, or did I retain the economic rights to use my property, or is it basically a condemnation of my property where I've lost the use of the property and it constitutes a sale? Well, if it's a sale, can we use the involuntary conversion rules to not have to report the income? So there's a whole bunch of stuff from a tax standpoint that is twisted into receipt of easement payments and the proper reporting of those payments. So it's a lengthy article. If you print it out, it's going to take up 3.5 to 4 pages, but there's all kinds of stuff as I go through that, talking about a limited easement and the type of payments, whether it's a damage payment or a severance damage or temporary easement or even a negative easement. Now, that's an interesting one there that we probably should explore at some point in time, because you can get into those with respect to environmental issues. And then the eminent domain and involuntary conversion issue, as I alluded to.
Well, as you mentioned, we will definitely get into these at a later date. And by the way, if they want to read, don't ask you this too often either, if they want to read that post in a little further detail, where can they find that at?
They can go to the homepage of my website, which is Washburn Law. Well, let me see if I remember that. I don't type in my website address very often. You can do a general search for it, and it's Washburn Agricultural Law and Tax Report, or just Walter, WALTR, and Washburn. It'll get you there. But it's washburnlaw.edu/Walter, WALTR. And then down the left-hand side. Yeah, down the left-hand side, you can find the link to the blog.
Okay, perfect. Well, Roger, hey, I appreciate it. I know you wanted to react to what the Secretary said, but I appreciate you doing that, and obviously we can get back to the other topics you wanted to discuss at a later date. So, as always, appreciate you joining us this morning.
Thank you, Greg.
That is Roger McEowen, Professor of Agricultural Law and Taxation at the Washburn University School of Law, as he joins us this morning on the Ag Issues program here on 580 WIBW.